One of the biggest myths people believe is that you need to be rich before you can start investing. That's completely false. You don't need millions of dollars. You don't even need tens of thousands to begin. What matters most is building the habit early. Just like going to the gym, consistency matters more than intensity at the start. Even small monthly investments can snowball into something massive over decades because of compound growth. Compound interest is one of the most powerful financial forces in existence. It means your money begins generating returns, then those returns begin generating their own returns, and eventually the growth starts accelerating. In the beginning, it feels slow, almost invisible, but over time it becomes incredibly powerful. That's why starting earlier matters more than starting big. So, how would I personally structure a simple $10,000 portfolio for long-term financial growth? I divide it into three major layers. The first layer is protection. Around 20% stays as an emergency fund. This money is not meant for investing or risking in the market. It's there to protect you when real life happens. Unexpected medical bills, car repairs, job loss, family emergencies, these things happen to everyone eventually. Without an emergency fund, people are often forced to sell investments during bad market conditions, locking in losses simply because they need immediate cash. That's why financial security always comes before aggressive investing. Having cash reserves gives you confidence and stability during uncertain times. The second layer is the long-term growth engine. This is where the majority of the money works for you over time. Instead of trying to pick individual winning stocks, I prefer diversified index ETFs that track the overall market. Funds connected to the broader U.S. stock market have historically produced strong long-term returns over decades because they spread risk across hundreds of companies instead of relying on just one. I also believe balancing stocks with bonds helps reduce emotional stress during major downturns. Stocks provide growth potential, while bonds can provide stability during periods of volatility. The exact percentages can vary depending on age and risk tolerance, but the core principle remains the same. Diversification reduces unnecessary risk while still allowing long-term growth. And that's the power of investing. Slowly turning money into something that works for you. Start small, stay consistent, and let time build your future. And that's the power of investing. Slowly turning money into something that works for you. Start small, stay consistent, and let time build your future.